Well, I think everything outside the Mag 7 is doing okay. We've had 8.5% earnings growth versus 8% expected, with maybe 15, a little bit more than 15, 20% of the S&P reporting. I think the big key is going to be next week with the serious Mag 7 earnings. Warren Buffett once said the three most important words in investing are margin of safety. And with the Magnificent Seven, there is no margin of safety. They're trading at 30 times earnings. Despite earnings growth falling in half year on year from 32% down to 14%. So far the themes with Netflix and Tesla have been what? Have been margin compression. And they're not even the biggest spenders in AI. We're going to see the biggest spenders in AI next week, and I think that we've raised a little cash, and I've been accused by some of your colleagues, Brian, by being a perma bull, and that's been the case, and that's been right. But in October, we got cautious and we raised some cash, and I think we want to have some cash through next week as we see a lot of spending and a lot of margin contraction in Mag 7.
Tom, to be clear, I never said that. All right, I just want that to be known on the opening bid roundtable. Let me fire back at you because you bring up a good point. These earnings are squashing estimates by and large. We're seeing a lot of companies like T-Mobile, Hasbro raise their outlooks today. They have not been alone, but profit margins have been under pressure. Tariffs, rising costs, you name it. Margins not for a lot of companies have been down year over year. Is the market just too excited by these earnings beats and they need to pay more attention to some of these fundamentals that may not be as strong as these earnings beats look like?
Yeah, look, I think we have to be a little cautious here. In years that the market corrects more than 15%, there's often a secondary correction, particularly after it hits all-time highs. So we corrected almost 20% in April. We went back to new highs. On average, the secondary correction is 3 to 9%. It averages 6.4%. It would not surprise me in coming weeks to see a little bit more chop and volatility before we finally get the year-end rally. And I think the catalyst, look, we are whistling by the graveyard a little bit. We got no deal with the shutdown so far. We've got no deal with China. We've got some open geopolitical questions, and we have a consistent theme of margin contraction with record high multiples. So that's the bad news. The good news is earnings are going to grow meaningfully next year, up double digits. But I think in the interim, I think people are going to be surprised how much this spending is weighing. And you saw Facebook or Meta lay off a bunch of people in their AI department. I thought that's where the growth was supposed to be.
Fair point. Inez, let me get over to you because I know our audience is probably saying, I wish Sazi would just shut the hell up about earnings. I want to focus in on Tesla. As you went through this Tesla earnings report, Inez, do you think of Tesla more as a car company or an AI company? It's a very important question we've asked in the past, but I would say now it's more important than ever before. I mean, they're rolling out robots, cars with no steering wheels. This is a fundamental change in the investment thesis in Tesla.
Yes, and Elon Musk in his opening remarks also, when he talked about Tesla, he really talked about AI, basically saying that Tesla is going to bring AI into the real world. So he is looking at Tesla as an AI company, and the company is clearly signaling that they are an AI play, that they are going into the humanoid robots and robo-taxis. And so that was the big focus during their earnings call. That's what struck me. I mean, we've seen this shift, but really last night you saw it even more. This is a what's next stock. And it is, and you're seeing that the stock is under pressure, perhaps because of the sort of margin squeeze, because of the earnings miss, because of perhaps the robo-taxi that safety drivers in Austin aren't going to be out of those until the end of the year. Maybe the progress was expected a little bit faster with respect to that, but it's definitely a what's next stock.
Ali, I know I'm supposed to be skeptical of companies and leaders, but I am getting more excited about these robots. I think there could be some real potential, and I think the Tesla robot, what is it, Optimus, this version 3 that Elon teased last night, is far and away the leader in this space.
Yeah, and Wall Street strategists that are bullish on this stock would agree with you. I mean, Dan Ives described it as the next era for Tesla. It's all about these robots. It's all about AI. But I agree with Inez that it truly is a show me story. What's next? What's coming down the pike? And for Tesla, I mean, what's making money right now, or trying to make money, is the car business. We're not seeing profits on the AI side. We're not at the point that we're seeing those returns. So investors are going to have to be patient. Clearly, given the results that we're seeing this morning, they're not so patient right now. They want to make sure that the expiration of those EV tax credits, that's not going to be a problem moving forward when you have these more grander ideas with AI and robots, especially since we know how difficult it is to make money in that space. So look, all these companies right now, if you can touch AI, if you can incorporate that into your business, that's a good thing. We know AI isn't going anywhere anytime soon, but it's a question of how long investors can wait around to see some of those returns.
Tom, I know you're a perma bull. Hit me with some picks. I heard you're showing up here on the round table with some picks for us.
Yeah, absolutely. One thing that no one's really been paying attention to, because everyone's been very skeptical about small caps. But if you look at small cap performance relative to large caps, it's dramatically outperformed since August of this year. So while everyone's been focused on Mag 7, what's actually outperformed in the last handful of months is small caps. So we got two great small caps for you. We brought on your show or on your network in the last little while, and they continue to go up, and they're going to continue to go up. One is a boring business, not trading at 200 times earnings like Tesla or 13 times revenue, actually much more realistic multiples. It's called Cooper Standard. They do the sealing systems around the doors and windows of automobiles and fluid transfer systems. This stock was down from $146 down to $5 when we started buying it in 2022. It subsequently dropped to $3.5. We bought more, and now it's at $35, $36. So six-bagger, but probably going to triple again from here over the next 3 years. And why is that? When it was $146, it was earning $7.20 on 17.5 million U.S. sell-through. They provide to U.S. OEMs like Ford, like GM, et cetera. It's a play on the recovery in auto volumes. We think they've taken about $400 or $500 million of costs out of the business. They're going to earn $10 a share at the top of the next cycle when we get back over 17 million cars. And depends what multiple you put on it. At 10 times, it's a $100 stock. If you go back to a 20 times multiple, it could be a lot higher. We like Cooper Standard.
Yeah. Inez, don't you always, aren't you amazed how guys like Tom find stocks like this? I got a lot of stocks in my head. This is what I've been doing for a while. I've never heard of this company.
I had never either, and this is why we love having Tom on, because he brings these stock picks that nobody had ever heard of. But listen, there is a stock for everyone and for everyone's interest.
So Tom, floor's yours.
I got one more. Canada Goose. It's not
okay. I've heard
just
Canada
about
Goose. I got a couple of their coats, but make your case.
It's not just about the $1,000 parkas anymore. They're doing 365 wear, from t-shirts to hats to eyewear to footwear. And you've seen it very successfully executed in other brands. They have record free cash flow and record revenues. And yet the stock is still down 80% from its COVID highs. The board recently rejected an offer for $14 a share to buy the company. Thank God they rejected that, because they would have stolen all the upside. And these are the type of divergences that we built our career on, when fundamentals are improving and the stock is down. Sooner or later, in the short term, the market is emotional voting machine based on emotions. In the long term, it's a weighing machine based on fundamentals. This stock price will catch up with the growing fundamentals.
Fair.